Welcome to Financial Roll Call. I'm Johnny, a police officer and military veteran. This channel is about discipline, long-term thinking, and building financial security the same way we build careers, through consistency, structure, and decisions that compound over time. No hype, no shortcuts, just clear thinking and repeatable systems. What if I told you there are companies that will pay you just for owning them, not for working, not for clocking in, not for overtime, but simply for being a shareholder? That payment is called a dividend, and today I'm going to break down what dividends are, how they work, why they matter, and how you can use them to build real passive income, because dividends are one of the simplest and most powerful wealth building tools available. Let's simplify it. A dividend is a payment a company makes to its shareholders. When a company earns profits, it has options. It can reinvest in growth, pay down debt, buy back shares, or distribute profits to owners. If it chooses to distribute profits, that's a dividend. If you own shares of that company, you get paid, usually quarterly. That's it. Ownership leads to payment. Mature companies that generate consistent cash flow often pay dividends. Think about Coca-Cola, Johnson & Johnson, Procter & Gamble, Home Depot, and McDonald's. These aren't startup companies. They're established businesses. They make steady profits, and they share a portion of those profits with shareholders. Why? Because it attracts long-term investors. Dividends signal stability, they signal cash flow, and they signal discipline. Let's say you own 100 shares of a company. That company pays a $1 dividend per share annually. That means you receive $100 per year, usually paid quarterly, so you receive $25 every 3 months. Now imagine owning 500 shares or 1,000 shares. The payment scales with ownership. This is why dividends reward consistency. The more you accumulate, the more income you generate. You'll often hear the term dividend yield. Dividend yield is simply annual dividend divided by stock price. If a company pays $2 per year and the stock price is $100, that's a 2% yield. Higher yield doesn't always mean better. In fact, extremely high yields can signal risk. You want sustainable dividends from strong companies with consistent earnings, not flashy numbers. Here's where it gets powerful. You can reinvest dividends. Instead of spending the $100 you receive, you use it to buy more shares. Now those new shares also pay dividends, and that compounds. Example, year one, $500 in dividends. Reinvest, buy more shares. Year two, $550 in dividends. Reinvest, buy more shares. And it grows. This is called DRIP, which stands for Dividend Reinvestment Plan. That's how dividends turn into a snowball. Some companies don't pay dividends. They reinvest all profits to grow faster. Those are growth stocks. Dividend stocks are different. They focus on stability, cash flow, and shareholder returns. There's nothing wrong with growth stocks, but dividend stocks are powerful for income seekers, long-term investors, and those wanting passive cash flow. You can build a portfolio that balances both. Let's do real math. If your portfolio grows to $250,000 with an average 3% dividend yield, that's $7,500 per year in income without selling a single share. Increase that to $500,000. Now you're looking at $15,000 annually. That's meaningful income, especially when combined with a pension, a 401k, a TSP, and other investments. Dividends don't make you rich overnight. They build income steadily. If you want to start earning dividends, step 1, open a brokerage account. Step 2, research stable dividend paying companies. Step 3, look for companies with long dividend histories. Step 4, start small. Step 5, reinvest consistently. You don't need thousands to begin. You need discipline. Over time, your dividend income grows. Dividends are boring. That's why they work. They require patience, consistency, and long-term thinking. Not hype, not timing the market, not chasing trends, just ownership and time. Dividends are one of the easiest ways to earn passive income from stocks. You don't need to flip houses. You don't need to start a business. You don't need to day trade. You need ownership, time, and discipline. Own companies that generate profits. Let them share those profits with you. Reinvest, repeat. That's how passive income is built. This is Financial Roll Call, and we build wealth with discipline. Briefing complete. I speak for myself, not any department. I provide the map. You drive the car. Do your own research. Stay safe.